In 1950, a man named Frank McNamara had an embarrassing experience that would accidentally create a financial empire. He was dining at a restaurant in New York when he realized he'd forgotten his wallet. That moment of panic led to a simple question. What if you could pay with just your signature and a card? Over the next 70 years, that question would transform into a trillion-dollar industry that fundamentally changed how we spend, save, and think about money. In this video, we're tracing the remarkable journey of how credit cards evolved from a luxury curiosity to an essential tool that's simultaneously empowering consumers and trapping millions in debt cycles that seem impossible to escape. It's 1950, and businessman Frank McNamara is enjoying dinner at Major's Cabin Grill, a high-end restaurant in New York City. The evening is going well until the check arrives and McNamara reaches for his wallet. It's not there. In an instant, a pleasant business dinner transforms into a mortifying predicament. With no cash and no means to pay, McNamara is forced to call his wife to bring money to the restaurant. As he sits there waiting, the humiliation burns deep enough to spark an idea that would eventually transform global commerce. McNamara wasn't just any businessman. His background in the food and restaurant industry had already given him unique insights into the challenges faced by both diners and merchants. That embarrassing moment at Major's Cabin Grill didn't just highlight a personal inconvenience. It revealed a fundamental inefficiency in how people conducted business. In the weeks following his restaurant mishap, McNamara couldn't shake the idea that there had to be a better way. Why should anyone have to carry cash everywhere? What if there was a system that allowed people to pay with just their signature, fundamentally shifting the entire payment paradigm from immediate cash transactions to a promise to pay later? It was a revolutionary concept, one that McNamara sketched out on a napkin during a follow-up meeting at the very same restaurant where he'd faced his embarrassment. McNamara wasn't alone in developing this idea. He partnered with his lawyer Ralph Schneider and businessman Alfred Bloomingdale to form Diners Club. Their initial concept was modest, a cardboard card that members could use at participating restaurants, with the bill to be settled at the end of each month. They started small, issuing cards to just 200 friends and associates who could use them at only 27 restaurants throughout New York City. The banking establishment's reaction was predictable: dismissive laughter. Many financial experts predicted the concept would collapse within months, viewing it as nothing more than a novelty for the wealthy. A rich person's toy with limited practical application. After all, who would want to change a payment system that had functioned adequately for centuries? But the skeptics couldn't have been more wrong. What they failed to recognize was the psychological breakthrough McNamara had stumbled upon. His innovation wasn't merely about convenience, it was about transforming the very nature of transactions. By removing the immediate exchange of cash and replacing it with a signature-based promise, McNamara had fundamentally altered the psychology of purchasing. The proof came quickly. Within just a year of its introduction, Diners Club had expanded far beyond its initial 200 members, attracting over 20,000 cardholders, a growth rate that stunned the banking industry and silenced many critics. The rapid adoption demonstrated an underlying demand that financial institutions had completely missed. Unlike modern credit cards, the original Diners Club operated as a charge card rather than offering revolving credit. Members were required to pay their balance in full each month, with no option to carry debt forward. This structure was crucial in establishing trust with merchants and demonstrating the viability of the system before the introduction of more complex credit arrangements. For participating businesses, the arrangement was compelling despite the 7% cut that Diners Club took from each transaction. Merchants found value in the promise of increased patronage from affluent customers and the guarantee of payment without the risks of handling cash or the hassle of maintaining individual credit accounts. By fundamentally shifting payment from the immediate exchange of cash to a signature-based promise, McNamara had created a psychological distance between purchasing and payment that would forever change consumer behavior. It was this conceptual breakthrough, not the physical card itself, that would ultimately reshape global commerce. This psychological distance between purchase and payment that McNamara pioneered was about to be weaponized on an unprecedented scale. In 1958, Bank of America conducted what might be the most reckless financial experiment in modern history, mailing 60,000 unsolicited credit cards to complete strangers without applications or credit checks. What could possibly go wrong? As it turns out, absolutely everything. The elite world of expense accounts and exclusive dining was about to collide with middle-class America in spectacular fashion. While the wealthy had been enjoying the perks of Diners Club for nearly a decade, ordinary Americans still operated in a cash economy. Bank executives who had once dismissed credit cards as a passing fad for the wealthy suddenly saw something revolutionary. Not just a convenience tool, but a potential profit engine that could transform the entire banking industry. Bank of America's Fresno drop was the financial equivalent of throwing a lit match into a gas station. They selected Fresno, California as their testing ground, a mid-sized community perfect for a controlled experiment. But there was nothing controlled about what happened next. Fraud exploded immediately. Default rates skyrocketed to a staggering 22% as people received cards they never asked for and spent money they couldn't repay. The bank hemorrhaged money, losing $8.8 million in the first year alone. The Fresno drop was initially disastrous, as historical accounts note. Cards were stolen from mailboxes. People used them without understanding the repayment terms. Some treated them as free money. The experiment seemed like a catastrophic failure, and banking industry observers predicted it would kill the consumer credit card concept entirely. Yet Bank of America persisted through the chaos, recognizing something that would forever change financial services. Unlike Diners Club, which required full payment each month, bank cards introduced a revolutionary concept: revolving credit. Customers could carry balances forward indefinitely, making only minimum payments while interest accrued on the remaining balance. This seemingly small innovation would prove to be the industry's most profitable invention. Despite the disastrous beginning, Bank of America refined their approach. They improved fraud detection, implemented better credit screening, and began to see the potential in their creation. Rather than abandoning the concept, they doubled down, creating a licensing system that allowed other banks across the country to issue Bank Americards under their own name. This network of affiliated banks would eventually transform into what we now know as Visa. The competition took notice. In 1966, a group of rival financial institutions formed the Interbank Card Association, the precursor to MasterCard, creating a second major network to challenge Bank Americard's growing dominance. These two networks would eventually become the backbone of global payment systems, processing trillions of dollars in transactions annually. What happened in banking boardrooms was nothing short of a complete philosophical reversal. The same executives who had mocked credit cards as an expensive gimmick for the wealthy now recognized them as the future of consumer finance. The reason was simple: interest income. While Diners Club made money from merchant fees and annual membership charges, banks discovered that the real profit center wasn't in facilitating transactions, it was in financing them. When customers carried balances month after month, paying only the minimum required amount while interest compounded on the remainder, banks had discovered a revenue stream that would become one of the most profitable in financial history. Consumer debt wasn't a bug in the system, it was the feature. The introduction of revolving credit fundamentally altered consumer psychology. No longer constrained by the cash in their wallets or the need to pay in full each month, Americans could now buy items they couldn't immediately afford. This simple change unleashed spending that would have been impossible in a cash economy, fueling both economic growth and personal debt in equal measure. Bank of America's persistence through their initial failure demonstrated extraordinary vision. What began as a disaster in Fresno would eventually grow into a global financial infrastructure handling billions of transactions daily. The banking industry had not just adopted the credit card concept, they had transformed it from a convenience tool into the cornerstone of consumer finance. By the 1980s, credit cards had evolved from a banking innovation to a mainstream financial instrument. But banks soon discovered that simply putting cards in wallets wasn't enough. The real challenge was getting consumers to reach for their plastic instead of cash. While banks had mastered the logistics of credit cards, they soon discovered an even more powerful tool than revolving credit: your own psychology. Behind every swipe lies an invisible architecture of psychological manipulation, so effective you've never even noticed it's there. When you hold a premium credit card, have you ever noticed that satisfying weight in your hand? That's no accident. Card issuers deliberately engineer premium cards with metal components to create a tactile experience that subconsciously signals value and importance. Your brain makes an instant connection. Heavier equals more valuable, more substantial, more worth using. This physical characteristic creates a subtle sense of satisfaction with each use, reinforcing the desire to pull out that particular card again and again. The psychology extends beyond weight to the visual realm. The colors chosen for credit cards are meticulously selected to evoke specific emotional responses. American Express's platinum and black cards, with their sophisticated minimalist design and dark color palette, aren't just aesthetically pleasing. They're deliberately designed to convey exclusivity and status. When you present that card, you're not just making a payment, you're making a statement about your financial standing. Meanwhile, Capital One embraces bright, vibrant colors that foster positive associations with spending, subtly encouraging more frequent use through visual cues that trigger feelings of optimism and satisfaction. Have you ever thought about why your signature appears on the back of your card? Beyond the obvious security function, that signature panel serves a deeper psychological purpose. By physically writing your name on the card, you establish a personal connection and sense of ownership with it. This small act of personalization transforms the card from a generic banking tool into your card, creating an emotional investment that makes you more likely to use it. It's a subtle but powerful psychological trick that increases your attachment to what would otherwise be just another piece of plastic. Perhaps the most profound psychological mechanism at work is what behavioral economists call the pain of paying. When you hand over physical cash, your brain registers a tangible loss. You can literally see your money leaving your possession. This creates a small but significant psychological barrier to spending. Credit cards brilliantly eliminate this friction. The simple swipe, chip insertion, or tap creates psychological distance between the act of purchasing and the actual payment, making spending feel less consequential. This distance is precisely what McNamara's original concept introduced, but modern banks have refined and weaponized it to unprecedented levels. The rewards programs attached to credit cards represent another layer of psychological engineering. These programs create positive reinforcement loops that encourage more spending through points, miles, or cashback. Each purchase becomes not just a transaction but an opportunity to earn something extra, triggering the brain's reward centers and creating a subtle dopamine hit that reinforces card usage. As behavioral economist Dan Ariely explains, the better consumers feel about their transactions, the more likely they are to return and spend again. Banks have masterfully created systems that make you feel rewarded for spending, even as they collect interest on balances and fees from merchants. The aspirational marketing surrounding credit cards completes this psychological ecosystem. Cards aren't marketed as debt instruments but as lifestyle enhancers and status symbols. Advertisements rarely focus on interest rates or fee structures. Instead, they show attractive people enjoying exclusive experiences, implying that the card is your ticket to a more sophisticated, enjoyable lifestyle. This frames credit card spending not as borrowing but as a form of self-actualization, a powerful psychological reframing that encourages usage while minimizing consideration of the financial implications. While the marketing strategists perfected the art of psychological manipulation, engineers were simultaneously working to erase the physical barriers between us and our money. What began with embossed cards and carbon copy receipts has transformed into invisible payments that happen with a simple tap of your phone. But this convenience came with an unexpected cost. As our money became invisible, so did our ability to control it. The technological revolution that would reshape our relationship with money began in 1970. That year, IBM collaborated with American Airlines and American Express to introduce magnetic stripe technology to credit cards. This innovation wasn't just a minor upgrade, it fundamentally transformed how transactions worked. For the first time, a credit card could be processed electronically, with authorization happening in seconds rather than minutes or hours. Before magnetic stripes, every credit card transaction required physical labor. Store clerks would place your card in manual imprinters, devices nicknamed knucklebusters for good reason, and create a physical impression of your card information. For any significant purchase, they'd need to call the bank directly, reading your card details over the phone to get verbal authorization. This process created natural friction in the spending cycle, a built-in pause that gave both merchants and customers time to consider the transaction. The magnetic stripe eliminated this pause. Suddenly, spending became smoother, faster, and required less conscious thought. While this technological leap made credit cards more practical for everyday use, it also began a pattern that would define the industry's future. Each innovation would make spending progressively easier while making the consequences increasingly abstract. The transformation continued through the decades. By the 1990s, a new revolution was brewing that would further distance consumers from the physical reality of spending money. The rise of online shopping meant you could make purchases without ever presenting a physical card. No longer did you need to open your wallet, remove your card, and hand it to a clerk. You simply typed numbers into a form and products appeared at your doorstep days later. This shift to digital commerce faced initial skepticism. Early online payment systems struggled with security concerns and the challenge of building consumer trust. Many shoppers were hesitant to enter their credit card details on websites, fearing fraud or identity theft. Yet, the convenience factor ultimately prevailed, and with each passing year, digital transactions became more normalized. By the 2010s, the evolution reached its logical conclusion. Mobile payment systems like Apple Pay and Google Wallet began eliminating the need for physical cards entirely. The transaction process was reduced to a simple tap of your phone, a device already integrated into nearly every aspect of daily life. The credit card, once a revolutionary payment tool, was becoming invisible, absorbed into the digital ecosystem. What's particularly interesting about this technological progression is the paradox it created. As payment technology advanced, removing friction at every step, consumers faced an increasingly difficult challenge maintaining awareness of their financial boundaries. When you physically handed over cash, you saw your wallet getting thinner. When you swiped a card, you at least performed a deliberate action tied to spending. But when payments become as simple as tapping your phone, or even just walking out of a store with automatic payments, the connection between the act of buying and its financial consequences grows increasingly tenuous. This technological streamlining has been associated with a measurable increase in impulse purchases. Without the tactile experience of counting bills or even handling a card, the psychological guardrails that naturally limited spending began to dissolve. Each innovation made transactions more convenient, but also more dangerous for those struggling to maintain financial discipline. The payment technology revolution represents a fascinating case study in unintended consequences. Systems designed to make our lives easier inadvertently made responsible spending harder. As we move from physical imprinters to magnetic stripes to invisible digital payments, we gained speed and convenience, but lost something important: the natural moments of friction that once helped us pause and consider whether a purchase was truly necessary. In the shadow of payment technology's rapid transformation, a handful of unlikely revolutionaries were quietly reshaping the future of global finance. While credit cards were becoming sleeker and more sophisticated, it wasn't the plastic that would ultimately matter. It was the invisible networks connecting them that would truly transform the world economy. The technology evolved rapidly, but who were the minds orchestrating this financial revolution from the shadows? While consumers focused on the convenience of their new plastic cards, a fierce battle was unfolding behind closed doors. One where former banking nobodies were about to rewrite the entire rulebook of global finance. Take D. Hock, a middle manager at a modest Seattle bank in the early 1970s. When executives handed him the troubled McNamara card program, they were essentially passing him a ticking time bomb. The program was drowning in fraud, operational inefficiencies, and mounting losses. Most banking professionals would have implemented conventional fixes, tighter controls, better verification processes, incremental improvements to the existing structure. But Hock saw something entirely different. Rather than patching the leaky pipes of a fundamentally flawed system, he envisioned something revolutionary: a decentralized organization where no single bank held control. His proposal for a nonprofit membership organization owned collectively by participating banks seemed borderline anarchistic to traditional banking executives. When he presented the concept, banking leaders openly laughed at the Seattle middle manager's audacious plan. "It's impossible," they told him. "Banks compete. They don't collaborate." But Hock's vision contained a brilliant insight that his critics missed. What if competitive institutions could simultaneously cooperate on infrastructure while still vigorously competing for customers? This chaotic organization, Hock's term combining chaos and order, would eventually become Visa International, a network that would ultimately process trillions of dollars in transactions annually. The brilliance of Hock's model wasn't just technological, but organizational. He recognized that for electronic payments to reach their potential, the system needed to accommodate competing interests within a standardized framework. Banks could still fight fiercely for customers while sharing the same payment rails, much like competing airlines using the same airports. Meanwhile, on the other side of the credit card battlefield, a parallel revolution was brewing. Russell Hogg faced his own impossible task at MasterCard, which was still a loosely affiliated collection of banks lacking the cohesion of McNamara's network. While American banking executives were focused on domestic markets, Hogg saw a different opportunity: global expansion into territories others considered worthless. Banking leaders ridiculed Hogg's strategy of aggressively pushing into emerging markets with underdeveloped banking systems. Why waste resources on economies that can barely support basic banking? Critics asked. But Hogg recognized something his contemporaries missed. Both Hock and Hogg shared a critical trait: they weren't blinded by industry assumptions. Where established banking figures saw only threats and complications, these outsiders recognized unprecedented opportunities. They weren't limited by traditional banking's rigid thinking because they weren't products of the banking establishment themselves. Their innovations went far beyond the cards themselves. While consumers focused on the convenience of plastic in their wallets, Hawk and Hog were building something far more significant: global financial networks that would eventually process trillions of dollars and connect formerly isolated economies into a unified commercial ecosystem. Under their leadership, these organizations transformed from troubled payment processors into financial empires. Visa became the most recognized financial brand globally, while MasterCard established itself as a formidable competitor with particular strength in international markets. Their networks became the invisible infrastructure upon which modern commerce now depends, as essential to global trade as shipping containers or the internet. As the invisible infrastructure of credit cards connected the world, a trillion-dollar paradox was quietly unfolding in American households. The same plastic cards celebrated as symbols of financial freedom were silently transforming into invisible prisons of debt, with the average family carrying over $8,000 in balances they could never quite seem to pay off. The 1990s marked a pivotal transformation in how credit cards functioned in society. What was once an exclusive tool for the wealthy and business elite had become a nearly universal financial instrument. College students received cards on their first day of class, while lower-income households found their mailboxes stuffed with pre-approved offers. This democratization of credit seemed on its surface like financial inclusion, but something more calculated was happening beneath the surface. The roots of this transformation trace back to a single piece of legislation that fundamentally altered the credit landscape. The Bankruptcy Reform Act of 1978 eliminated long-standing restrictions on interest rates, suddenly allowing banks to charge rates that would have been illegal just years earlier. Rates that could exceed 29% annually became the new normal. Charges that would have been considered usurious and predatory under previous banking regulations. With these new profit opportunities, banks didn't just accept high-interest customers, they actively sought them out. Their technology evolved from simple credit checking systems into sophisticated behavioral prediction algorithms. These systems didn't identify who was most likely to repay their debts in full. Instead, they pinpointed who would carry balances month after month while reliably making minimum payments. The industry even developed specialized terminology for their ideal customer: revolvers. This wasn't a nickname, it was a business classification that revealed the true nature of the credit card business model. The most profitable customers weren't those who paid in full each month, but those who remained perpetually indebted, making just enough payments to avoid default while maximizing interest revenue. By the early 2000s, this strategy had generated staggering results. American credit card debt surpassed $1 trillion, a number so large it's difficult to comprehend. Behind that figure were millions of households trapped in cycles of minimum payments that barely touch their principal balances. A $3,000 balance at 19% interest with minimum payments would take over 16 years to pay off, generating more in interest than the original purchases. The credit card had become both savior and captor. For a family facing an unexpected car repair needed to get to work, the credit card offered immediate salvation. But that same solution often became a long-term financial burden, as interest compounded month after month. The system created dependency by design, offering immediate relief at the cost of prolonged financial strain. Banking executives didn't view this evolution as problematic, but rather as the natural optimization of their business model. Credit card divisions became the most profitable segments of many major banks, often generating returns that far outpaced traditional lending. The revolving credit model had proven itself to be extraordinarily lucrative, an ever-replenishing revenue stream that required little additional investment once a customer began carrying a balance. What's perhaps most revealing is how the marketing of credit cards deliberately obscured this reality. Advertisements focused on rewards, benefits, and aspirational lifestyles rather than interest rates or repayment terms. The psychological distance between spending and payment, already expanded by the card's design, was further widened by marketing that portrayed credit cards as tools of opportunity rather than potential debt instruments. So where do we go from here? As financial experts point out, our current credit system stands at a crossroads. The convenience that credit cards offer comes with significant debt challenges for millions of Americans. While we've traced the evolution from McNamara's napkin sketch to today's trillion-dollar industry, we're now witnessing growing calls for alternative payment models that deliver similar benefits without the accompanying high-interest debt risks. The cashless revolution continues to accelerate, but questions remain about who truly benefits. This isn't simply about technology. It's about financial power, psychological manipulation, and economic inequality. The most meaningful innovations ahead may not come from new payment technologies, but from reimagining the fundamental relationship between consumers and credit providers. As we move forward, the most pressing challenge isn't technological but ethical, creating payment systems that prioritize consumer financial health rather than profitability built on perpetual debt. The future of payment may not be about new ways to borrow, but new ways to spend responsibly. If you found this video insightful, like, share, and hit the subscribe button to join our community for more deep dives into untold financial history stories and groundbreaking revelations shaping the global economy. Click the next video for another intriguing narrative. Thanks for watching.